This is a training video aimed primarily at the bookkeepers on how to adjust for opening balances. What these are typically are adjustments made by the accounts team when they've prepared the year-end accounts, which have not yet been reflected in the third-party accounting software, such as QuickBooks, Xero, and Sage, etc. In this example, we've taken the accounts from CCH and selected the balance sheet and compared it to the balance sheet prepared in QuickBooks. The first thing to make sure we get right is that we're comparing the correct dates, in this case 30th of June 2022. The accounts in CCH show total reserves of 10,122, whereas the accounts shown in QuickBooks show reserves of 362,269. So we have a difference of £352,147, which we need to adjust for to bring QuickBooks in line with CCH. The next thing we need to do is open the working papers file, which is found either in Document Manager under CCH or wherever we decide to save the file on the new tax calc software, which we're currently in the process of installing. Once you've opened the Excel file, you need to select the ETB tab. The ETB is a summary showing how we've arrived at the figures in CCH. The column shown in red shows the figures that we've taken from QuickBooks in this instance, and they represent the balance sheet that we saw 2 slides ago. The figures in the 2 blue columns are all the journal entries that we've made, and the figures in the green column are the figures that are shown in the CCH accounts. So it's those figures in the 2 blue columns that we need to process in QuickBooks to arrive at the figures shown in CCH. And you'll notice that they're made in 2 columns, as I previously mentioned. First one is marked journals, and there is a separate sheet showing a breakdown of all those journals. The second column is a single adjustment for the corporation tax charge. To access the journals in the working papers, you need to click on the tab marked journals. And this shows you a breakdown of all the journals that were shown in the left-hand blue column on the ETB. Before we progress to the journals in QuickBooks, just want you to have a quick look at this this journal in the blue box. What this is a journal processed in CCH just for presentation purposes only. All it's doing is splitting the loans between amounts due falling within 1 year and amounts falling due after 1 year. And we don't need to process that in QuickBooks because we're not bothered about presentation. So I just want to make you aware that we don't need to process this journal. Okay, so what we're going to do now is just process those journals in QuickBooks. So we click on the plus new journal entry. First thing we need to do is change the date to be the year end journals relate to. Okay, and we simply just go through those journals and process them. Let's do that then. Okay, the first one was directors current account. I'm going to call them closing balance. You'll notice that some of the headings in QuickBooks aren't necessarily the same as the headings in the accounts production software. You've just got to use your common sense really as to which those accounts are. Okay, let's crack on. Remember, journal 3 we didn't need to process because it was just a reallocation within the balance sheet. It was just splitting the loans before and after 1 year. That was just a presentation, so we don't need to do that one here, but we do need to do the rest. The dividends, if we note, are an expense, not a liability. Those are the journals that we processed, but we've got to do one final adjustment, which was that corporation tax adjustment. So we need to debit the corporation tax payable, which is an expense. And then credit the liability. Totals agree. And then we can just click save and post. Okay, so the next thing we need to do is just check that the closing balances per CCH equal the closing balances on QuickBooks. So we'll just go into reports and have a look at the balance sheet total. See what the figures show. From memory, we're looking for a figure of £10,122. There you go, total net assets, £10,121.65. So we know that the opening balances have been processed correctly. So what would we do if the balance sheets still don't agree? Well, this would only really happen if there was a late adjustment put through QuickBooks after we'd finished the accounts on CCH. This shouldn't happen because the accounts team are supposed to lock QuickBooks and they're doing the accounts to prevent this very thing from happening. But it might happen. Generally, these will only be supplier invoices. Typically, they'll have been uploaded by Dext. The client might have found an old receipt that they hadn't remembered and just zapped it through the app on Dext. Well, in this situation, what you've got to do is find out which transactions have been put in late, which isn't that difficult, and then go into QuickBooks and redate them as the first day of the new accounting period. And the way we do that is you would run a report in QuickBooks for the aged creditors and compare to the report that's been saved in the working papers file.